The global banking system is one of the most powerful, yet misunderstood machines ever built. There are more than 30,000 banks worldwide, controlling tens of trillions of dollars in assets. The top 10 banks alone hold around $25 trillion. Today, banking looks impossibly complex, but its original purpose was surprisingly simple: to make trade easier. In the 11th century, Italy was the center of European commerce. Merchants from across the continent gathered to trade goods, but there was a major problem: too many currencies. In cities like Pisa, traders had to deal with 7 different coins, constantly exchanging money just to do business. These exchanges happened on outdoor benches, or banco, which is where the word bank comes from. As trade expanded, dangers increased: theft, counterfeit coins, and the difficulty of securing loans. This led to a new system. Money brokers began extending credit, and merchants developed early cashless payments. Banking networks spread across Europe, lending not just to traders, but to churches and kings. Fast forward to today, and at its core, banking is still about risk management. People deposit money and earn modest interest. Banks lend that money out at higher rates, knowing some borrowers will default. This process fuels the economy by turning idle savings into homes, businesses, and growth. Beyond lending, banks earn money through deposits, credit cards, currency trading, custody services, and cash management. The problem is that many modern banks drifted away from this role. Instead of focusing on long-term stability, they chased short-term profits through complex financial products and aggressive trading. Before 2008, banks took massive risks, rewarded executives with huge bonuses, and treated finance like a casino. When banks like Lehman Brothers issued mortgages to nearly anyone, risk piled up unseen. When the housing market collapsed, stock prices crashed, banks failed, and a global financial crisis followed. Hundreds of billions of dollars vanished. Millions lost jobs. Trust in bankers collapsed. Governments stepped in with massive bailouts to prevent total collapse, buying bad assets and propping up the system. New regulations forced banks to hold emergency capital, but stronger reforms were weakened by lobbying. Since then, alternatives have grown rapidly. New investment firms charge flat fees instead of commissions, aligning incentives with clients. Credit unions, member-owned cooperatives, focus on community value rather than profit maximization. They provide the same services as banks, but take fewer risks, which is why many survived the last crisis better. Crowdfunding has also exploded, allowing people to fund projects and businesses directly, bypassing banks entirely. Risk is spread across thousands of small investors, and innovation thrives. Microfinance has taken this even further, offering tiny loans in developing countries to people once excluded from the financial system. What began as social aid has grown into a multi-billion-dollar industry. Banking may seem distant, but its role is essential. Society needs systems that move money from those who have it to those who can use it productively. The real question isn't whether banking will exist in the future, but who will control it, how risk will be managed, and whether it will serve society or endanger it again.